Portfolio Builder members, welcome to our Thursday trade alert where we trade the TLT ETF, that's the 20-year treasuries. And we've also now added into today's trade alert a option caller for GDX. So there's some big news that we'll take a look at, but basically the Trump team appears desperate to get a trade deal at all cost, and so here comes the China trade deal. Vroom. Is it something we really want? Probably not. We'll have to see what the scope of this trade deal is. But our long positions in the SPY and emerging markets have hit a maximum profit, and our TLT has hit the maximum loss. So net, let's take a look at our returns. And I do want to note out for members that I noticed our gold position had not been tracking over the past few months because of a formula error. And so here's our updated returns, which brings our average return per month to 1.36% per month, and essentially brought down our August return slightly. So let's take a look at today's trade alert, and we'll see how we're positioning for a short-term pullback in bonds and gold. Now the big picture remains intact. We have too much debt. The Fed has to slowly but surely drop these rates to be able to fund all these debts, and the US government is creating $1 trillion deficit per year. That's most likely going to only grow if Trump can do an infrastructure project or anything of that nature. But even without that, we're already sitting on massive levels of debt, which would make you think the yield would have to go up. But if that were to happen, the entire bond market could collapse. And so I think the Fed will continue to slowly drop interest rates as long as they can until they get to that zero band. So big picture, we still want to be long TLT and GDX. Short term, we're trying to protect against some volatility and make some extra money. It is actually more profitable for us to do the inverted collars. I just rarely like to issue them because the entire market is engineered for both of these asset classes to slowly go up while we're facing such huge levels of debt. So here's a summary of the Thursday trade. The TLT went from 141.37 to 135.56, a vicious move to the downside for a loss of $5.82. Our protective collar cut off those losses the second we went below 138, which is where we had our put, and delivered a 249 profit. The net return on the TLT week over week is negative $3.32. We've had this in our P&L for the entire time period, so we actually showed a gain in our net return day over day because of emerging markets and SPY hitting our maximum profit. The key macro Trump team appears desperate for a trade deal and willing to roll back tariffs to secure Chinese agricultural purchases ahead of the election. And also China is going to sentence to death 2 fentanyl smugglers. So we'll see what else is involved in this trade deal. But overall, this should, in general, be very bullish for emerging markets and the SPY. Although we are at some pretty nose-bleeding valuations on the SPY, I do think it will travel considerably higher, especially if this is accomplished. And there's also a new Trump speech coming out on the 12th, so that could be another catalyst. So we'll take a look at some of the potential potholes along the way for this narrative. But again, our average return is now at 1.36% per month, and we've only had one losing month out of 11 months. And this has been primarily from playing it safe. We've been positioning against a trade deal breaking down and protecting against volatility from that. So I'd say overall we've done a great job protecting our nest egg and still generating a positive return during this past 4 months where the markets have been highly uncertain. We keep getting this news that we have a trade deal, and then just a month later it gets broken down. So we're not through the finish line yet, but we are seeing both parties mutually say they will do this trade deal, and we're seeing Trump bend over backwards to make this happen. So for now, the narrative is long equities and then short bonds and gold. Now we have a very clever way to do that. We'll take a look at that in a minute. Here's a look at our SPY portfolio. It is up 1.7% in November and also pulled in a 1% return in October. So it's been doing very well in the last 2 months, and I suspect it will continue to do so. In our Tuesday play, we're up 2.6% in November. That's playing emerging markets. And again, this smaller piece of our portfolio is designed to take on more risk. The bond portfolio has averaged 1.18% per month over the past 11 months and has nearly half of our profits year to date, although it has had some trouble in the last 2 months as the trade war was not breaking down. And so all this money that has been hoarding into bonds is now fleeing for the exit. Now, this is also at a time where JPMorgan is dramatically buying up these long duration bonds, and Warren Buffett's at an all-time cash high. So I'm not ready to bet down on the TLT for a very long period of time. Just want to let these yields reset, let the S&P 500 probably climb a bit higher, and then most likely open back up a long position in the TLT and GDX. Because when we do look at the big picture, the central banks are trapped, and nothing short of an economic miracle would make all these central banks think they can start to raise rates again. In fact, already queued up for the next 2 months are some 23 central banks which will lower interest rates. And Bank of England actually voted last night with 2 of their voting members that they did want to drop rates 25 basis points. And so also we're starting to see China increase its credit, which is the big missing picture to the global slowdown. Is China going to be able to increase their credit and turn back on the global growth engine narrative? Meanwhile, our precious metals have been getting beaten down for a couple months now. And so we're officially putting on the tight collar now that it does seem clear there will be a trade deal. I would suspect this will put some downside pressure on both the bond market and the gold market at this time. Big picture again, I do intend to flip our option callers to be bullish, most likely in the next 4 to 8 weeks after we see what exactly is going to come of this trade deal and let all these prices reset. Here's a breakdown of our return. In the last 11 months, we've returned 15%, and this has been with extremely low drawdown. So it's one thing to generate a 15% return just buying the SPY and sitting back and hanging on to massive volatility. But with our strategy, we've been able to do it by overlapping different asset classes that are highly uncorrelated and then using the option market to help skew those profits and generate very high returns with extremely low drawdown. So our biggest level of drawdown from a month-to-month perspective is still at negative 1%. So that's a very, very nice risk to reward ratio and why we've been able to grow our service so quickly. Here's again a look at the returns per month. December, that's when you really need a service like ours. 15% sell-off in stocks. We generated 1% return. Do we outperform the SPY? No, we don't, and we're not trying to. The strategy is not designed to do that. It's designed to protect capital and to be risk adverse. So we did generate a positive return in January, February. Then comes May, 2.2% return against a 7% sell-off in the S&P 500. We also did well in the upside, but just not as well as the S&P 500 did. And then come in August, we did hit a 0.8% return, not 1.8. So I did catch some errors in our gold portfolio, which have now been reflected and fixed. And so you can see our new return over these last 3 months is 0.8% in August, 0.2% in September, and 0.3% in October. And again, this entire period, we've been playing it very defensive, positioning ourselves in case the trade deal broke down. We would have actually had a substantial gain. So considering this was really the smart move, there's no reason on earth to think a trade deal would have been formed, and we're still not through the finish line. I don't regret any of our strategies and positions. And though we have not quite met our 1% target per month over this 3-month stretch, we've played it safe during a very risky time period. Had this trade deal broken down and you're sitting long equities, you could have seen another pullback like December. So the change to the portfolio is to drop the extra 50 shares on GDX. And we're going to now team it up with the Thursday trade and use the option callers, at least for the next several weeks, to protect and actually profit from a projected down move in the TLT and GDX and an upward move in the SPY and emerging markets. So let's take a look at the trade alert today. First step is trade alert 1 to close your November 8th, 2019 144 TLT call. And I apologize, that is an error. And then to sell to close your November 8th, 2019 138 put. Now the next half of the trade is to sell to open the 135 TLT call and to buy to open the 136 TLT put. So let's go look at that trade. Here's how to get out of the previous trade. You can see we had a huge return on that put option, actually over 1,000% return on that 138 put. That did help offset a lot of the drawdown on the TLT. And then meanwhile, on our new trade alert, we are now positioning for a down move in the TLT. So we've sold the in-the-money call at 135, and we've bought the in-the-money put for 136. So let's take a look at our risk profile. For this trade, we can generate a maximum profit of $58 at the expiration. So actually, because we're going to close this out on a Thursday, there will be some time premium left in this trade, so we can actually get better than $58 per contract. Now, if the TLT were to rapidly rise and go up in value, our maximum loss on this trade is $42. So we've really tightened the collar on this and turned it into an inverted option collar. So this will allow us to profit from down moves in the TLT, and we can actually get better returns from betting down. It's just very rare that we want to put that trade on. Meanwhile, now that we have rounded our GDX to an even 100 shares, we're doing a very similar setup. We're selling the 2650 call for 42 cents and then buying the 27 put for 77 cents. So a credit of 42 and a debit of 76. And here's our potential risk reward on this trade. On this setup, we can lose as much as $29.50 per 100 shares, and we can gain as much as $20.50 on the downside. So we're playing these two downward bets very conservatively. We have certainly missed some of this down move already, and I do think it will be a short-lived sell-off in both of these assets. Meanwhile, we will be ready to continue to take risk on the equities position, which has been generating some nice gains over the past several weeks. And in fact, if we go back to those returns, we can see that in the SPY ETF, we have had a 1% return in October and a 1.7% return in November. And in our equities portfolio too, on Tuesdays, we've had a 4% return in October and a 2.6% return in November. Jump to a quick piece about our service, and then we'll jump into the top news we've collected over the past 12 hours. Daily income trade alerts delivered at noon Eastern. Here's our updated trade allocation: 54% equities, 38% bonds, and 8% gold. We trade the SPY ETF Monday, Wednesday, Friday, the Emerging Markets ETF on Tuesday, and now combined the TLT and GDX on Thursday, Currently, we're long the SPY in emerging markets and conservatively short the TLT and GDX. Now on the equities, we still have that tight option collar as we're still not through the finish line. This is all on a hopeful narrative where we're seeing both counterparties show signs of a trade deal. Our target income is $750 per month per $75,000 invested, or 1% per month. Our average return is just under 1.5% per month. Some months we are above 1%, some months we're below, but on average it's been at the 1.35% after this recent sell-off. So we just reviewed our returns per month, so I'll skip through that. And again, our simple 4 ETF portfolio is extremely diversified and all you'll need for retirement. The SPY is 500 companies, the emerging markets ETF is 1,000, and GDX is over 55 gold miners. Our goal is to generate income and safety, not growth or speculation. You can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. And if you're ready for a free portfolio consultation, please call Dean at 505-322-7515. He can walk you through how the program works in great detail, answer all your questions, and get you started. Also, if you're a member and you'd like to upgrade to a lifetime membership, stop paying that annual bill, you can get 4 weeks free in our boot camp. So just call Dean again at 505-322-7515. And if you do look in the description box, you can find a lot of resources, including our trade alerts, every single update, the track record, a link to apply to our advisory service, as well as Dean's phone number. And a reminder, we have our freebie webinar coming up in about an hour and a half. This is an educational webinar where I'll teach you everything about our strategy, why the SPY and TLT combined together make for such a powerful pair, and what I think will happen in the next couple of years in the markets. So just check your email 1 hour before for your access link. And if you can help us out, please like this video and subscribe to our channel. And make sure to click the bell for automatic notifications of our daily YouTube video. Here's a look at our disclaimer, and then we'll jump into the topical news I've collected over the past 12 hours. And good morning, Ron. Thanks for saying hi and hopping in the chat. You're our #1 live streamer. Okay, so let's take a look at the top news. U.S. futures jumped to record high after China says U.S. agreed to roll back tariffs. So we're agreeing to roll back tariffs to get China to go back to buying the same level of agricultural products they were doing prior to the trade war. Are the farmers going to be happy that they've been punished for 2 years just to go back to exactly where they were? I guess the silver lining is that this is just in the first year. By year 2, they're supposed to actually get to nearly double what they had been purchasing in the past. That and also China is putting to death, sentencing to death some fentanyl smugglers, so Trump can go push his two highlights: that he got a trade deal, that he's getting them to stop stealing intellectual property, that he's got them to agree to increase farming purchases over the next 2 years, and to stop the drug abuse. So we'll see if it really happens. This is not the first time we've heard this song. China says U.S. has agreed to phase out tariffs. The offshore Yuan and CNH surged more than 400 pips, breaking through that 7 level. Will the U.S. farmers be happy that they suffered 2 years of tariffs just so Trump can keep his stock gains? Hello, Oscar. How's it going, buddy? How's the weather in Florida treating you today? Here's from Bloomberg. This was from the night before, so we saw the morning of that this was actually being confirmed by both sides. Tuesday, November 12th, we may be getting some hints about the trade deal and what's actually in it at the Economic Club in New York, so that's something we'll keep close eye on. And this was last night. They were leaking that the U.S. had been asking for President Xi's travel schedule. Then we get the news that there's a NATO summit in London on December 3rd and 4th, which may be where Trump and Xi can meet to sign this deal. Meanwhile, China is running a massive fiscal deficit as a percentage of GDP. They're simply running out of dollars. This is from Kyle Bass. He must be very upset. He's been ready to... gloomy day for the TLT. So we have flipped the option caller, Oscar. And so we may be able to make some extra profits on the TLT betting down for a few weeks here, but we won't be doing it for long. They're simply running out of USD with investment flows into China being curtailed. The US holds all of the cards in the negotiations to reset our relationship with the evil regime. And so U.S.'s debt to GDP is in the negative 2% range, while theirs officially is closer to 5%. Unofficially, many people are anticipating that it's more like between 15 and 10%. So that's a massive amount of debt to GDP growth. And again, if the U.S. had continued to apply pressure, I do think China would have collapsed and created a recession. So now we'll closely monitor China's credit creation and impulse and see if they're going to continue the debt binge and try to gain a lot of capital from markets with this trade deal, which is what I would suspect they would do. But both of these parties have caught us off guard many times before. And don't forget, earlier in the year, we had a huge trade agreement that was days from being signed, and the Chinese crossed out 90% of it and sent it back. So there may be some surprises still in the door for us here. Meanwhile, Germany is still in trouble. Industrial output printing negative. And so the big picture is that the global slowdown is already in place. Can they print enough money and lower interest rates to get us out of it like they did in 2011 and 2015 for one last hurrah? Perhaps, without the pressures in the trade war. Meanwhile, Fed says inflation pressures are very muted. Of course, that's just if you ignore all asset classes, healthcare, residential, college tuition. So it's really a joke. We know that they should be raising rates, but they're just trying to delay the inevitable. Now, if you're in the boot camp, you did get to see this interview. It was about 15 minutes. Ray Dalio, rock bottom rates allowed companies to sell dreams instead of earnings. So there's a lot of private equity that is at these massive billion-dollar evaluations in the private equity markets, and most of them are not generating profits. The second this credit crunch really happens, they're most likely going to see another dot-com crash in terms of private equity companies. Printing money is the easiest path because it is the most hidden way of creating a wealth transfer, and it tends to make asset prices rise. Ray Dalio. Meanwhile, yesterday we had a stellar 10-year auction. Foreign demand surges. So these guys probably be a little upset with their purchase today after the big move down this morning. And the big picture again is that the U.S. has massive amounts of debt, and in order to service it, we have to keep rates low and gradually drag them lower unless we have a miracle in GDP and tax receipts. So right now that's just not the case. We're showing slowing growth. The benefits of the tax cuts are wearing out. They're talking about some new tax cuts to release next year that might give it another little boost. But as long as we're creating $1 trillion deficit per year, the pressure is going to continue to mount. And the only option the Fed has is to buy up those treasuries and put them in the balance sheet and to lower interest rates. If they don't make the bond market believe this is the long-term path, you're going to have a massive rush to the exit. Pound tumbles after 2 Bank of England members unexpectedly vote for a rate cut of 25 basis points. And they had been pretty firm for quite some time. Meanwhile, some extra wild cards that potentially could stir things up in upcoming weeks and months is the impeachment inquiry. Adam Schiff announces the first public impeachment hearings. Meanwhile, Trump Jr. outs the supposed CIA whistleblower who used to work for Joe Biden, was heavily involved in Ukraine. So if this is really the whistleblower, that'll be quite interesting, and he can be called in as a material witness. McConnell, Twitter's plan to ban political ads would just reinforce the privilege of speakers who are already powerful or famous. Nonprofits and little-known candidates deserve the same tools as multi-million-dollar media corporations to make their voice heard. So now Twitter's getting bashed from both sides. Senate Democrats are still blocking the annual funding for our armed forces. House Democrats are still blocking the USMCA and 176,000 new American jobs. Democrats' 3-year-old impeachment journey is now crowding out even the most basic bipartisan legislation. Here's a new one from Elizabeth. My family lived on the ragged edge of the middle class. When my daddy had a heart attack, it nearly sent us over a financial cliff. Today, the cost of health care is the #1 reason why families go broke. No more. We need Medicare for all. And then she had a little piece out about Bill Gates. Bill Gates was saying, I'm happy to pay $8 or $10 billion, but when you want me to pay $100 billion, then I got to think twice. And here was her reply. I'm always happy to meet with people, even if we have different views. At Bill Gates, if we get the chance, I'd love to explain exactly how much you'd pay under my wealth tax. I promise you, it's not to $100 billion. So her wealth tax is 2% of your net worth per year. So you can do the math, something like 35 years and you're almost down to zero. But when you say I should pay $100 billion, then I'm starting to do a little math over what I have left over. And that was the quote from Bill Gates. Here's a look at some charts. The SPY ETF spiking to 309. If you remember, I've been predicting a range of 315 to 330 for quite some time, ever since we had that phase 1 trade deal. And even before that, we've been predicting that the most likely outcome of a phase deal would be rolling back tariffs, buying some agricultural products. There'll probably be some easing for Huawei built into this trade deal. We'll see what exactly the language is on the IP theft, but most likely that is pushed to part 2. So perhaps we see something like the 2018 rally. And what happened in that was we had the S&P 500 climbing higher and higher with this adrenaline boost from tax cuts and increased profits until the 10-year Treasury hit around 3%. And that became too attractive, and money flooded over from the stock market into the bond market. So I would suspect something of that nature is in the books for the next several weeks, and we could see the SPY climb to that 315 to 330 range. Most likely we'll see downward pressure on the TLT and GDX during that period, and then I think we'll see a nice reversion from there. Gallagher the Great is in the house. That's funny. Yes, he is. Here's a look at that TLT pulling back. Big picture again, the Fed is trapped. So this is most likely a short-term downside move in the TLT. And what's interesting is if this does get out of control, it might actually freak out the Fed. The next Fed meeting is in December, and the last thing they want are credit markets getting out of control. So right now they're in this whole we're going to wait to drop rates mode, and so we'll see if they push that through in December, and if so, how the market reacts to that. But if they did want to curtail this rush to the exits in the credit markets, they may actually surprise us with another rate cut, which may stop the TLT bleeding a bit and then put even more ammo into S&P 500. So we'll be curious to see how the Fed reacts to this optimism coming into the next Fed meeting. Here's a bigger picture of the TLT. Just how low could it go? Well, we have dropped the interest rates 3 times this year, so that will keep some upward momentum on the TLT. But if we look to the levels we had prior to this trade war escalation, there's a lot of downside ahead, potential downside. And it wasn't until we got to this 112 level on the TLT that we really saw stock market get into some serious trouble. So most likely, unless we see things starting to falter in the trade talks, unless we see something really outrageous come out of the impeachment inquiry, unless we see something very negative in economic data on the U.S. side, I would suspect we can play the inverted collar on the TLT for probably around 8 weeks at the longest. Here's our GDX, which has had some drawdown. But again, the big picture is the central banks are trapped. China has to print more money to keep this GDP going. The overall picture is the money supply is most likely going to dramatically grow in the next 12 to 24 months. So we want to be long gold. Did the miners get a little ahead of themselves? Did the spot gold get a little ahead of itself, assuming that the trade talks would break down? Sure, and I think the whole world was defending against trade talks breaking down. And so we'll see if we can really get the trade talks through the finish line. Meanwhile, here's the last piece of our portfolio, emerging markets. My target to just get to the 2017 high is up to 52. So we've been playing this one for several weeks now and had some great gains on it. And I believe there is some considerable further gains to be achieved before I'll want to tighten that collar up. And potentially in about 4 to 8 weeks, once we hit some of these nose bleeding levels on equities, we'll flip. We'll go to inverted on the SPY and emerging markets, and then bet that we see some money flow out of stocks, take profits, and start to buy up these bonds at the lower bond price and higher yields. All right, guys, that is a wrap for today's update. And don't forget, we do have a free webinar coming up in about an hour and 10 minutes now. You'll get a link in your email to access that. And we'll be going through our whole strategy in detail, teaching you everything you need to accurately follow the program, protect your nest egg, and generate consistent returns without all the volatility.